To me, I think one of the things we really need to talk about is how interest rates have changed. I mean, when we were starting the year, I mean, debt was as cheap as it can be, and kind of it's not as dramatic as gas prices going up so quickly, but the debt world has changed.
Yeah, I think it's what's similar and somewhat worse than the gas prices is that debt has kind of left the table for a while. People are so scared of where rates might be going that their spreads would be too low that a lot of the banks have almost closed their doors for a period of time to let the pricing gather out. So I think that we're working on an industrial deal right now in Northern California, and we've got 75 lenders that have looked at it. We're now going out to another probably 50. We'll have 125 lenders, none of which are anywhere near the guidance we had when we first priced the asset. So you're going to see pressure on interest rates to go up, which is going to force cap rates to go up and change underwriting for every deal type across the country.
Do you think? I mean, this is a smaller deal. It's not like the one
Yeah.
we just closed. Does a smaller deal aspect change it's just not worth the risk for the lenders, or?
Well, it's interesting because I was talking to our mortgage banker on this deal, who's also working on some larger things, and she mentioned a large investment bank, top 3 investment bank, that had 2 investment committee meeting approvals, not formal yet, to do a deal for a major national sponsor. They went into final approval, and it got rejected. Not retraded, not changed, completely rejected because they didn't like where interest rates were going and where they were. I don't think we've seen that since the Great Recession.
Yeah.
So the material adverse change language came back in the 1990s with some of the other crises that we've been through. We're in that material adverse change kind of world where people are really looking around saying, where's this going? What do we do? And I think the lenders are just scared right now.
Yeah. But it's not like they didn't have any forewarning that interest rates are going up. I've only heard that for the last 10 years.
Yeah, I think that's right. I mean, we've said for 10 years that where do interest rates go from zero, right? They go up. But we also didn't have a Ukrainian war. We didn't have the shortages of gasoline and oil. We didn't have the price of oil, which did spike around 150 at one point. It's now over 100 again, bouncing around 100. I think all those things come into be why that material adverse change language was first came about, was to protect the lender and not the borrower.
But what about all the debt funds that they were everywhere a year ago?
They're there. They're just wide. They just really widened out. I mean, and the deal we're working on, as you mentioned, in California is a smaller deal. So now you're dealing with these banks who, whenever they get scared, they want to go to recourse. Right. So I think if we were to say, we have a deal.
We don't like that word.
No, it's a 4-letter word. It's a 4-letter word. But if you go to the smaller banks and you say recourse, I think you could probably get the execution we were talking about in the beginning, or close to, but without the recourse. Basically, what you've got to prove to the bank is you're wealthy enough that you don't need the loan, you just want the loan, and then they'll make you a loan. And that's where I think, especially on the small deals we are right now. The big guys, the sophisticated guys, are really on the sidelines trying to see how far they want to widen and what they want to do. And I haven't heard of an investment bank going through 2 investment committees with approval and then wholeheartedly just saying no to a deal.
We just lost on a deal. We were in the best and final, so maybe we won, but it was a much bigger deal in Stockton.
Right.
That was just awarded last week. I wonder if they're going, is that sponsor now going, oh my God, the debt market's a lot different than I underwrote?
Well, it's interesting is I think they have to be. The good news for the person who beat us out is that they're still in their due diligence period. So they're going to have an opportunity to come back and look at what that means. But returns, I mean, what's happening to interest rates on any size deal right now, in my opinion, has lowered the IRR on that same deal by 200 basis points minimum, just because of the debt. I think you're going to see lower advance rates and you're going to see low and higher interest rates. The 2 combination there is a deal that used to be a 15 IRR is going to be a 13 or lower IRR if you use the same underwriting.
So this could be it's not a recession per se. But you think this is going to put some brakes on multifamily and on industrial?
I do. I think what's going to happen is everybody's looking at cap rates. I mean, people are buying apartments. We talked to one of our high net worth family offices. They're selling a portfolio of apartments for a 2.7 cap, right? That's not sustainable. That's not going to last. So typically, you look historically, and interest rates and cap rates have had a 75 to 150 basis point spread. In about a 2-week period, that collapsed almost zero, depending on what asset class you're in. So that also is not sustainable. So I think we're probably going to see a widening of cap rates on the buy. Everybody's going to be underwriting much wider cap rates on the sell because interest rates aren't expected to come back down.
Yeah.
And the Fed's talking about doing 5 to 7 interest rate hikes. So
they
only move in quarter points. That's a pretty big jump if they get to 7 of those. So
does that become the new recession, in that deals just stop getting done, or do you think people will adjust?
I think that it's a good question. I think in core real estate, where they don't rely as much on debt, cap rates will move, but not as significantly. In the core plus up to value add and opportunistic, they're going to have to move pretty aggressively. So I think you're going to see a hesitation. Let's regroup. Let's see where we are. And then people will come back, because what we've proven is, except for the Great Recession when everybody had to close their doors for a little bit, people buy through cycles. Yeah. Nobody tries to be a perfect market timer. So we'll go through a 30, 60-day readjustment, and then I think volumes will get back up again. But I think every sales broker right now is scrambling to keep their deals together because interest rates have moved so far.
Yeah. What do you think about how we look at it? I mean, we meet once every Monday for a couple hours to go through everything. In the last week, we haven't really talked about changing our underwriting, but it's gotten all too real to us in the last week.
No, I've talked to every one of our guys, and I said, I want to see exactly what you're underwriting. I mean, we just bid out a large apartment deal, and I just asked to see what that underwriting is on the debt, because I'm virtually certain it's wrong.